then learning objective number 3, which is make or buy. Make or buy. The make or buy, when a company is involved in more than one activity in the entire value chain, it is vertically integrated. When we are talking about a product, then the production, maybe we do have more than one component for this product, okay? And the production or the process called the value chain. A decision to carry out one of the activities in the value chain internally means make it internally instead of buying it from outside. This is the question about the objective thing. So we're talking about making it inside the company or buy it from outside. Let's say about the bottle of water. Most likely, if you read what is written in the bottle, they said that this is exported from X company, from outside the company. So why they don't make it internally? Because they definitely calculate what is the cost of making and what is the cost of buying, rather than to buy it externally from a supplier. Is called make or buy decision. Make or buy decision. Now, vertical integration about the value chain, smoother flow of the parts and materials, better quality control, and we realize profits. Companies may fail to take advantage of the supplier who can create economies of scale advantage. Economies of scale, if you learn about this word, if we buy more, then we have a discount, right? So this is called the economies of scale. Some companies do not need that much of these parts of these bottles, maybe, so they don't buy an amount for the product which can be applicable for the demand from numerous companies, while they're careful to retain control over the activities that are essential to maintaining its competitive position. Let's see an example. It can be much more clear. The make or buy decision, an example. Essex company manufactures part 4A. We do have a part included in our product called 4A that is used in one of its products. The unit product cost for this part is materials, labor, overhead. Means what? Means making inside or buying from outside? Making. When we say direct material, we are paying $9 per material or per unit of material, which means we are making this part. Labor for $5, variable overhead for 1, depreciation of special equipment for 3, supervisor salary for 2, general factory overhead $10, and the unit product cost, if we make it internally, I will pay $30. This is what we have internally, or what we have if we make this part inside the company. The special equipment used to manufacture part 4A has no resale value, which means, go back to the question, which means the depreciation for the special equipment, is irrelevant. What is irrelevant means? If the equipment used to manufacture this part has no resale value, which means if I buy it from outside, the machine and its depreciation will be irrelevant for my decision, because, or in other words, I will pay the depreciation or the cost of the machine in both cases, if I buy it from outside or make it internally. The total amount of general factory overhead, which is allocated on the basis of direct labor hours, would be unaffected by the decision. General factory overhead, go back again. The general factory overhead, which is the $10, the $10 will not be changed if I buy or make, which means also irrelevant. If you remember the word relevant or irrelevant, I said the relevant information, which is the information that differs between the alternatives. If we have the same information of same costs in choice 1 or choice 2, this information will be irrelevant and should be avoided in my decision. The $30 unit product cost is based on 20,000 parts produced each year. This is the required and the capacity. An outside supplier has offered to provide the 20,000 parts at a cost of $25 per one part. So we do have a decision to decide whether we should buy it from outside for $25 or make it internally for $30. This is our question for this objective. Should the company stop making the parts for A and buy it from outside supplier? Why? Because only we depend on if we depend only for the price would be 25, but the making is 30. If we depend only for this information, definitely we can go for buying it from outside. Now, our decision, should we make it or buy it from outside? Let's summarize the decision by drawing two columns. The first column called buying it from outside or making it inside, okay? If we buy it from outside, then we have to pay $25 per one part, then multiply by 20,000 units, and then we have to pay $500,000 if we buy it from outside, okay? Now, the comparison is not to say $30 multiplied by $20,000, which is $600,000. If we make it, we are paying 30, is it? From our question, from the information. We cannot say 30 multiplied by 20, which is 600, and the 500 is less. No, because we have some irrelevant information, Irrelevant means we have to pay it, whether we buy it from outside or make it internally. So in this decision, we will exclude the irrelevant information. So the making decision in the first column, we will include only the relevant, which means the avoidable costs that can be avoided if we buy it from outside. Direct material, if we make the part internally, we have to pay $9 per one unit for the material. So this cost is $180,000. Direct labor, we are paying $5 for the labor multiplied by 20,000. So this equals to 100,000. For the variable overhead, we will pay $1, so $20,000. For the depreciation, we will exclude it from our decision. Why again? Because we have to pay it whether we buy or make. So this will be excluded from our decision. The supervisor salary can be avoided, $2, so $40,000. The allocated general factory overhead cannot be avoided, which is irrelevant, and we have to exclude it from our decision. Now, the making cost for the 20,000 units can be $340,000. $340,000. The avoidable costs, which are these four only associated with making the part, include direct material, direct labor, variable overhead, and the supervisor salary only, which means the others are not avoidable. The cost incurred to buy the equipment is a sunk cost. Something happened in the history, something happened in the past. So we cannot change the cost of the machine, which is called a sunk cost. The depreciation related to this equipment simply spreads this sunk cost over the equipment's useful life, which is also irrelevant for our decision. The allocated overhead again, the allocated overhead, and most likely the word allocated means we cannot avoid it, most likely. Allocated general overhead, which is $10 per 1 unit, multiplied by 20, which is 1,000 units. Allocated general factor overhead represents allocated costs common to all items produced in the factory and would continue unchanged. Thus, this is irrelevant for our decision. The word allocated means it has happened in the two cases, which means it is irrelevant for our decision. Now, the final answer can be, in this case, should we make or buy, given that the total avoidable costs, which is 340,000, are less than the cost of buying the part, which is 500, then we can say we do have an advantage for what? For making, not buying. Why? Because we do have a positive number 160,000, a positive number as an advantage for the making, not the buying. So Essex should continue to make the part, and we have to analyze the make or buy in this way and don't depend on only the price for our decision. Okay. So something related also to the make and buy. Opportunity costs are not actual cash outlays and are not recorded in the formal accounts for the organization. If you remember the word of opportunity cost, which is the foregone, forfeited option. Okay, so it is a second choice that I've given up if I choose my alternative. So we cannot see it in our financial statements. Opportunity cost is a benefit that is foregone as a result of pursuing some course of action, which is because you choose your alternative now, you're forgone or you're given up another choice. So this is called the opportunity cost. Now, if the space to make the part 4A had an alternative use, the opportunity cost would have been equal to the segment margin that could have been derived from the best alternative use in the space, which means if, for our question, if we have a place to make this part and we can do something for the place, we can have a benefit for that place, which means this is an opportunity cost. We do have an exercise about the opportunity cost. If it is related to the make and buy, we have to include the opportunity cost for our decision. Any question? Special order. Objective number 4, special order. Prepare an analysis showing whether a special order should be accepted or not. What is the special order? The word special order, or sometimes they call it a customized order. The special order is a one-time order that is not considered part of the company's normal ongoing business. When analyzing a special order, only the word and the important word you have to consider, incremental costs or benefit, are relevant. What does the incremental means? Incremental means additional. Incremental means additional costs or benefits will be relevant. Since the existing fixed manufacturing overhead costs would not be affected by the order, they are not relevant. The fixed costs, which has happened already without or with the special order, so we will exclude the effect of the fixed cost because it is irrelevant. Example, Jet Incorporate makes a single product whose normal selling price is $20 per 1 unit. So our normal price is $20. We are selling our product for $20. A foreign distributor offers to purchase 3,000 units for $10 per unit. So we have a special order, but the price will be $10 instead of $20, which is half of our price. This is a one-time order that would not affect the company's regular business. A positive point that we can accept. Annual capacity. The word capacity is important here. Why they give us the capacity for 10,000 units, but Jet Incorporated is currently producing and selling only $5,000? Why they give us the capacity? And we heard about this word in chapter 1. If you remember, the example was the company capacity ranges from 18 to 22. What does that mean? Or what is the point that it is related to the capacity? The fixed costs. Fixed costs are paid up to 10,000 units. If you remember the example of chapter 1, when we say the company ranges or produces from 18,000 to 22, which means the fixed costs are paid either we produce 18 or we produce 22. We have to pay the same amount of the fixed costs. So we do have a capacity. Now the question is, if we don't have a capacity, that means we have to refuse. Why? Without calculation. Why? Because if we exceed the 10,000, we need to pay more for the fixed expenses. Okay, so to accept or reject the special order, we have to also include the incremental fixed costs, which is the additional fixed cost happen for this company. So our annual capacity is 10,000. We are producing now 5,000. So if we accept the 3,000, we still playing within our capacity, which is 10,000. Should the company accept the offer or reject it? What we have now, the contributions income statement before considering the special order. We are selling 5,000 units multiplied by our normal price, which is 20. We have recognizing revenue for $100,000. The variable costs, so we do have materials, labor, manufacturing overhead, and marketing costs in a total of $40,000. $40,000. So the per one cost or variable cost is equal to $8, which is calculated from what? 40,000 divided by 40,000 total variable cost divided by what? 5,000 units. So we are paying $8 as a variable expenses. Okay. Contribution margin 60,000, difference between sales and variable costs. Fixed expenses, manufacturing overhead 28, marketing cost. Look, the marketing cost repeated here in the fixed cost and the variable cost. So this is the part of marketing, but it is variable. And this is a part of marketing, but it is fixed. Okay. Now we do have $48,000 as a fixed costs, net operating income of 12,000. Now, should we accept the offer or reject it? We can talk about only incremental. Again, incremental means what? Additional costs and benefits, right? Additional revenue that we recognize if we accept the offer will be 3,000 times the price times the 10. So the incremental, again, what is the incremental means? Additional revenue that we recognize. So incremental revenues will be 3,000 times 10 for 30,000. We will increase our revenues. This is the meaning of incremental by 30,000. So the total revenues will be what?
30,000.
No, the total for the company will be what? The 100 plus the 30. So total revenues for the company will be 130,000. Is it? the incremental costs will be 3,000 times the variable costs that we have to produce these 3,000. So we have incremental variable costs for $24,000, right? Do we have any change in the fixed expenses? No. If we have any change in the incremental in the fixed expenses, we have to add a line here called incremental fixed costs. Okay, but from our question, we don't have any change for the fixed expenses. That's why we do have an additional, if you like, incremental net income for 6,000. So we do have an advantage. If this number is positive, as we say, we do have an advantage of accepting the offer. Again, if the company accepts the special order, the incremental revenue will exceed and incremental costs will also increase. In other words, the net operating income will increase by 6,000, which is the difference between the incremental revenues and incremental costs. So the company should accept the order. Again, note this answer assumes that the fixed costs are unavoidable and that variable marketing costs must be incurred on the special order, which means all the variable costs are happened already or there already. Okay then. Quiz. Northern Optical ordinarily sells the X-lens for $50. $50. The variable production cost is $10. The fixed production cost is $18. And the variable selling costs is $1. This is what we see. Now, a customer has requested a special order for 10,000 units. 10,000 units of X-lens to imprinted with the customer's logo. We need, or we have a special order, but we need a machine or a special order to have a logo for that specified or specific customer. Okay. This special order would not involve any selling costs. In this case, we have to exclude that $1, right? But Northern Optical would have to purchase an imprinting machine for $50,000. So we have a special order for a lens, and this special order needs a machine to print the logo of that customer. So we are not using this machine after that for anything else. What is the minimum or the bottom, rock bottom minimum price below with Northern Optical should not go in its negotiation with the customer, which means what is the minimum price that you accept for the special order? In other words, below what price would Northern Optical actually be losing money on the sale? There is a ample idea capacity to fulfill the order, and the imprinting machine has no future use after this order. This means what? We do have change in the fixed costs and we have change in the variable cost. What do you think? We have to include incremental costs, which can lead us for the minimum price that we can accept. So the variable production cost, which is 100,000, right? 100. The additional fixed costs, we have to purchase a machine for this special order of 50,000. So total relevant costs will be 150,000. Now, the minimum price that can I accept for the 10,000 units, which is 15, comes from 150,000 divided by 10,000 units. So at least we will accept the 15. The 15 gives you what, by the way? The break even. The break even. So we don't have any profit. So the minimum price that we can accept is 15. Yes. Learning objective 5. Determine the most profitable use for a constraint resource. Constraint resource. Constraint resource means what? A limited resource. Limited resource. Companies are forced to make volume trade-off decisions when they do not have enough capacity. And this is the word or the important word for this topic. To produce all the products and sales volume demanded by their customers. In these situations, companies must trade off or sacrifice production of some products in favor of others in an effort to maximize our profit. So we're talking about limited resources, limited resources. When a limited resource of some type restricts the company's ability to satisfy the demand, the companies is said to have a constraint or something called limited resource. The machine or process that is limiting overall output is called a bottleneck. It is a constraint. Utilizing of the constraint resource. Fixed costs are usually unaffected by these situations or in these situations. So the product mix that maximizes the company's total contribution margin should ordinarily be selected. If we exclude the fixed expenses because it is unavoidable, because it is irrelevant, this means that we consider the variable expenses, which means we are talking about the contribution margin. A company should not necessarily promote those products that have the highest unit contribution margins. Rather, total contribution margin will be maximized by promoting those products or accepting those orders that provide the highest contribution margin in relation to the constraint resource. Now, our topic here, talking about maximizing our profits. We have a demand more than our resources. That's why we have to choose the best choices that maximizes our profit. Ensign, our Ensign company, produces 2 products and selected that are shown below. Product 1, product 2. Selling price for 1 is 60, for 2 is 50. Variable expenses 36, 35 respectively. Contribution margin is 24 and 15 respectively. Current demand per week 2,000, 2,200. Contribution margin ratio is 40, 30%. Processing time required on machine A1 per 1 unit. 1 minute for product 1, half a minute for product 2. Now, our question is, we do have a limited resource. Machine A1 is a constrained resource and is being used as 100% of its capacity. There is an excess capacity in all other machines, but this specific machine, we do have a limited resource for it. Machine A1 has a capacity of 2,400 minutes per week. Should Ensign focus its efforts in product 1 or product 2? Now, our limited resource is the time for the machine. We do have maximum 2,400 to use our machine. Should we accept, or should we start with product A, which needs 2,000 units, or product 2, which needs 2,200 units? Referring to the contribution margin for the unit, it is not accurate if we choose the contribution margin, the bigger from 1 or 2, it is not suitable. Why? Because the time needed for each product is different. Okay, so the solution can be like this. How many units of each product can be processed through the machine in 1 minute? In 1 minute. For product 1, we need 1 minute only, but for product 2, referring to the question, we need half a minute to produce product 2, is it?
No.
So for 1 minute, we can produce 2 units from product 2, 1 unit from product 1, right? What generates more profit for the company using the 1 minute of machine A1 to process product 1, or using 1 minute of machine A1 to process product 2? The 1 minute, with 1 minute of machine A1, the company makes 1 unit of product 1 with a contribution margin of 24. That's why be careful about the contribution margin. We are looking for the contribution margin, but the contribution margin for the machine, not the contribution margin for the product. Now, the 1 minute can give me $24 contribution margin from product 1. Easy. Why? Because we need 1 minute for product 1. But for the 2 products or 2 units of product 2, each with a contribution margin of $15, we can say we will recognize contribution margin of 30 if we produce product 2. Why? Because for the 1 minute, which is our constraint, we can produce 2 units from product 2, which means $30 contribution margin, not 15. Why? Because the 15 refers to 1 unit. But in 1 minute, we can produce 2 units. That leads us to the solution or the answer. We will calculate something called contribution margin per minute. We are not talking about the unit here or the product. The key is the contribution margin per the unit of the constrained resource. Now, our limited resource is the machine here. Our limited resource is the machine, right? So we are talking about the contribution margin per our constrained or limited resource. So it is the minute. We do have a limited resource for our machine. So the maximum that we can produce 2,400 minutes. That's why we have to calculate something called contribution margin per 1 minute. Now, for product 1, the contribution margin per 1 unit is 24, divided by the minute or the minutes needs for product 1, which is 1 minute from the question. So the contribution margin per 1 minute will equals to 24. But for product 2, the contribution margin is 15, but we need the required time to produce the 1 unit is half a minute, which means the contribution margin for the 1 minute will be $30. That's why the company maximize its contribution margin by producing product 2, not product 1. Ensign should emphasize product 2 because it generates a contribution margin of 30 per minute of the constant resource relative to 24 for product 1. Product 2, so we will have to start with product 2, and if we have an excess for our minutes of machine, we can go back to product 1. Look at the solution here. Allocating our constrained resource machine. We have to start with product 2, as we say, because we are maximizing the contribution margin per minute. So we have to say product 2, weekly demand for product 2, they ask for 2,200 units, multiplied by the time required, which is half a minute. We need 1,100 to fulfill the whole demand of product 2. Okay, so we are fulfilling product 2 first. Why? Because it's maximizing our contribution margin, and then we go back to product 1. So we need 1,100 minutes to fulfill the whole demand of product 2, and then the total time available for our machine is 2,400 minus the times that we need to product 2, 1,100. We still have a time for the machine 1,300. This time can be used to produce product 1. So divided by the time required of product 1, which is 1 minute. Now we have only to fulfill 1,300 units of product 1. Why? Because we don't have any excess time available for our machine. Then we have to fulfill product 2 and then go back to product 1. According to the plan, look, product 1, 1,000. According to the plan, we produce 2,200 units of product 2 and only 1,300 product 1. Given this information, product 1, 1,300 multiplied by 24, which is the contribution margin. The total contribution margin achieved by fulfilling product 1 is 31,200. And we are fulfilling 2,200 from product 2. Multiplied by $15 contribution, so 33,000. The total contribution margin, which is the maximum, if you like, maximum contribution margin can be achieved by the company using the limited resource of machine, is equal to the total, which is 64,200. 64,200. Okay, I will jump to learning objective 7. Learning objective 7. Okay, guys, prepare an analysis showing whether joint products should be sold at the split off point or processed further. This is a very interesting topic. Very interesting topic. Look, in some industries, two or more products known as joint products are produced from a single raw materials or material input. The point in the manufacturing process where joint products can be recognized as a separate product is called a split off point. A decision as to whether a joint product should be sold at the split off point or processed further is known sell or process further. Look at this example. The joint product or joint input here is what? What you can imagine, what is the joint input? If we produce from that input oil, gasoline, and chemicals, what will be the joint inputs for the example? The oil, the oil. Okay, the raw oil, come on, petrol. If we extract the oil, the raw oil, we can sell it as it is, or we can go further to produce the gasoline, to produce the chemicals, or the oil used in some industries, and we sell it after production. This is the question. Another example, if you have raw milk, we can sell the raw milk as it is, or to produce it more. What does produce it more means? Give me an example from the yogurt or cheese or something else. So should we sell it as it is or produce more and sell it after that? This is the topic of chapter of objective 7. For example, in the petroleum refining industry, a large number of products are extracted from the crude oil, the oil as it is, extracted from the ground, including gasoline, jet fuel, or fuel, home heating oil, or any other chemicals used in the industry. Now, if we need to decide to sell it as it is, means sell it at this point, and this point is called split off point, okay? Or to sell it after further processing and sell it at the final stage here. So we have to compare between two things, to sell it at the split off or to further or process further. So the oil, after the split point, we can produce the oil, gasoline, and the chemicals, okay? The oil needs a separate processing to be sold at the final or after processing here. The gasoline, we don't need any further processing, so we sell it here. The chemicals, we need a separate processing, and after that, we can sell the chemicals. Now, the joint costs are traditionally allocated among different products at the split off point. Typical approach is to allocate the joint costs according to the sales volume of these products. Okay. An example. And again, we will depend on something called incrementals. A company cuts logs from which unfinished lumber and sawdust are the immediate joint products. Wood. Unfinished lumber is sold as is or processed further into finished lumber. Sawdust can also be sold as is. As is means what? Before further processing, okay? 2, gardening wholesalers or processed further into presto logs. Now, we need this information. Data about sawmills joint products includes sales volume at the split of 140 for the lumber, 40 for the sawdust per log. Sales volume after further processing, 270, 50 respectively. Now, the meaning of after processing, if we do a further processing for the lumber, we can sell it for $270. Okay? We can sell the sawdust after processing for 50, but before processing as 40. Allocated joint costs, 176 for the lumber, 25 for the sawdust. Cost of further processing, 50 for the lumber, 20 for the sawdust. The number that we will ignore is the what? The joint for the decision of selling or further processing, we will exclude the joint. Analysis of sell or process further. Again, look at the word incremental. Incremental means the additional or the benefit. If we process further, do we have a benefit? If not, then we have to sell it at the split off. If we have a benefit, then we can sell it after processing. For the analysis for sell it in the split off or sell it after the further processing, we have to say that we need to compare between the sales volume after processing and the sales volume in the split off. Okay, so these two numbers are the sales referring to the lumber or one product. The difference or the incremental sorry, the incremental revenues for further processing will be 130 for the lumber minus the costs that happening after the processing, which means after the split off, which is 50 given in the question. If we do a further processing for the lumber, we can earn an $80, which is a positive number, which means we do have a benefit if we sell it after further processing. Okay, but for the sawdust, we have a difference in the revenues, $10, which is the 50 minus 40, an advantage for the revenues. But we do have a further processing cost of $20, which means we do have a loss or a disadvantage. It is not a loss actually, a disadvantage if we process further for the sawdust. So we will advise for go further for the lumber and sell the sawdust in the split off point. The decision will be what? The lumber should process. The lumber should process further. The lumber, the first product, should be processed further, and the sawdust should be what? Sold at the split of Y, because we have a disadvantage if we go further for this product. Again, the summary for this topic, the summary for the process further or split off. Go back to the graph, much better for this topic. This here. Now, guys, for an example, the oil again. If we have an advantage of go further for the oil, which means the incremental revenues recognized from go further of the oil exceeds the separate or the processing cost of go further. Yes or no? If we go further for the oil, we have to compare between two things. If we have an advantage to process further, advantage means what? The difference between the revenues recognized and the costs recognized. Yes? We do have a sales volume for the oil here before processing and sales volume after processing. So this is the difference of revenues. Compare this amount with the costs happened between here and there, which is only the separate processing cost related to the oil. Okay, now we are comparing between two things again, the revenues recognized and the costs happened after processing. Good. If we have a positive number, we can say this is advantage, so go further for the oil. Gasoline we don't need, so it should be sold at a split off, right? For the chemicals, again, we compare between the benefits and the disadvantages or the costs, and that's why we have to decide for the joint products, or sell or further, sell at split off or sell after processing. The irrelevant information for this topic is what? The irrelevant, we don't use this information. The cost of the raw what?
Raw material.
Not material, the raw product, which is called the joint products, the joint input or cost, the joint cost. So the joint cost is allocated here, but it will not be considered for your decision to sell here or to sell further. Okay, that's all. Thank you.